Thinking about holding crypto on your company's balance sheet? Or using it to pay vendors or employees? The IRS has issued new rules on crypto tax basis tracking, and they change how companies must account for these assets. Here's what you need to know. First, remember this. The IRS treats crypto as property, not as cash. That means every time you sell, trade, or use crypto, even for a business transaction, it could create a taxable gain or loss. That's why tracking the asset's cost basis is critical. In 2024, the IRS issued new rules that change how cost basis is tracked. The key change: each wallet must now be treated as a separate pool for basis tracking. That means you can no longer apply FIFO or specific identification across multiple wallets. Everything must be tracked within each wallet individually. Why does this matter? Before, many taxpayers used universal FIFO across wallets and exchanges, for example, treating Bitcoin on Coinbase and in cold storage as one combined pool. Under the new rules, this approach could lead to mismatches with broker-reported information starting in 2026, creating compliance risk. So what's considered a wallet? According to the IRS, a wallet is any method of storing your crypto private keys, whether electronic or otherwise. That includes exchange accounts, hardware wallets, seed phrases, and even self-custody setups accessed from multiple devices. The IRS distinguishes two important wallet types. Hosted wallets involve a custodian, like a crypto exchange. Unhosted wallets refer to pure self-custody, where the user holds their own private keys. It's also important to know that not all hosted wallets qualify as brokers for IRS reporting purposes. There's another distinction too. Hot wallets are connected to the internet. Cold wallets are kept offline, offering more security but less automation. There are two main methods for recovering cost basis: specific identification, where you choose exactly which units of crypto you're selling, using contemporaneous records. FIFO, first in, first out, the default method if you don't make a specific ID. Each method must be applied within a single wallet and used consistently. If you're using specific identification, the IRS lays out two paths. For self-custody assets, you must use books and records to identify the asset being sold at the time of the sale. For broker-held assets, you can provide instructions to the broker, even standing instructions. One key rule: you must identify the asset before or at the time of sale, not after. The IRS is giving temporary relief for the 2025 tax year. Since many brokers aren't fully ready to support specific ID, taxpayers can continue using internal books and records to track sales of broker-held crypto, but this relief expires after 2025. Full broker-based enforcement is expected in 2026. The podcast also highlights an important tax planning point: capital losses. If you don't track basis correctly, you could generate capital losses you can't fully use, or even trigger unexpected capital gains. Proper tracking helps you avoid inefficient outcomes and better align tax results with your business goals. For corporate tax departments, it is recommended that you understand whether your company uses crypto for investment, operations, or both. Clearly group and separate your wallets. Implement a tracking system. Spreadsheets won't cut it. Establish internal procedures to ensure consistency, audit readiness, and compliance with IRS regulations by 2026. Consider this. If your business pays vendors or employees in crypto, each payment creates a barter transaction under tax law. That means every transfer must have cost basis and fair market value recorded, and the resulting gain or loss must be reported, just like selling property. To hear these insights directly from the experts, check out the full episode of Deloitte's Tax News and Views podcast, Understanding Crypto Tax Basis Tracking.